September 14th, 2008. It's a Sunday night. No markets are open, no trading floors are running, no alarms are going off, yet. But inside a building in Lower Manhattan, the most powerful men in American finance are sitting in a room. The Treasury Secretary is there. The heads of Goldman Sachs, Morgan Stanley, Citigroup, JP Morgan, all there. They're not celebrating. They're negotiating who survives the night. And by morning, one of them wouldn't. If you think Lehman Brothers collapsed because of bad loans and reckless bets, you're right. But that's only the version they want you to remember. Because the real story isn't about the loans. It's about a decision, a deliberate, calculated decision made in that room to let one of the most powerful banks in the world burn to the ground. And the people who made that decision, they walked away clean. And somehow, it gets worse. Let's back up. Lehman Brothers wasn't some rogue startup. It was 158 years old. 158 years of surviving the Civil War, 2 world wars, the Great Depression, Black Monday, all of it. It had survived everything. It had outlasted empires. At its peak, Lehman Brothers managed over $600 billion in assets. $600 billion. That's more than the entire GDP of most countries. They had offices in 26 cities, 25,000 employees, a stock price trading in the hundreds, and they were untouchable, or so everyone thought. Here's the version you probably know. In the mid-2000s, Lehman went all in on the American housing market. They bought mortgage-backed securities by the truckload. They packaged subprime loans, loans given to people who had no business getting them, and sold them as safe investments. And for a while, it worked beautifully. The housing market was on fire. Prices kept going up. Everyone was making money. So Lehman doubled down, then doubled down again. By 2008, they were leveraged 30 to 1. $30 of borrowed money for every $1 they actually owned. That's not investing, that's gambling. With someone else's chips. When the housing market started cracking in 2007, Lehman held on. When Bear Stearns collapsed in March 2008, Lehman held on. When the losses started piling up, $3.9 billion in a single quarter, Lehman held on. And then one Sunday night in September, they ran out of road. That's the official story. Bad bets, too much leverage, inevitable collapse. But here's what that story leaves out. 6 months earlier, in March 2008, Bear Stearns was in the exact same position. Same bad bets, same toxic assets, same death spiral. And what did the government do? They saved it. The Federal Reserve engineered a rescue deal. They guaranteed $29 billion in Bear Stearns assets and handed the company to JP Morgan Chase for $2 a share. The government stepped in. The bank survived. Crisis averted. So when Lehman started falling, everyone assumed the same thing would happen. The government would step in. They always do. Except this time, they didn't. Why? That's the question nobody can fully answer, and the one everybody should be asking. Some say Hank Paulson, Treasury Secretary, former Goldman Sachs CEO, didn't have the legal authority to bail out Lehman without a buyer in place. Some say they needed to make an example to send a message to Wall Street that moral hazard had limits. Some say the decision was political, that another bailout was impossible to sell to the American public. And some, the ones who were in that room, say they simply ran out of options. But here's what we know for certain. On the night of September 13th and 14th, 2008, Paulson, Geithner, and Bernanke called every major bank CEO into a room at the Federal Reserve Bank of New York. They told them, "We're not saving Lehman. You are. Find a buyer. Pool your resources. Figure it out amongst yourselves." The banks scrambled. Barclays from the UK showed interest. Bank of America circled. But by Sunday morning, Barclays pulled out, blocked by UK regulators who refused to approve a deal without a shareholder vote. Bank of America pivoted and bought Merrill Lynch instead. And just like that, Lehman had no buyers. No buyers, no bailout. And 158 years of history ended at 1:45 a.m. on September 15th, 2008. Here's where it gets dangerous. Within hours of the bankruptcy filing, global markets began to process what just happened, and what they realized broke them. If Lehman could fail, if a 158-year-old institution with $600 billion in assets could just disappear overnight, then nobody was safe. Not banks, not funds, not your savings account. The panic was immediate. The Dow Jones dropped 504 points on September 15th, its biggest single-day drop since 9/11. But that was just the beginning, because Lehman wasn't just a bank. It was a counterparty. It owed money to, and was owed money by, hundreds of institutions around the world.